1919, the heart of London's financial district, a group of the most powerful men in gold gather around a mahogany table. The room hums with anticipation, for this is where history will be made. They represent 5 of the world's leading bullion dealers, N.M. Rothschild and Sons, Mocatta and Goldsmith, Pixley and Abel, Samuel Montague & Co., and Sharps Wilkins. Every day at 11 a.m., they will meet to set the price of gold, a ritual known as the London Gold Fix. Over the next century, this clandestine gathering would control the global gold market, influencing trillions of dollars in trade. It's not just about setting the daily price, it's about manipulating supply and demand to ensure profits for members at the expense of others. But why should you care? Because the London Gold Fix has shaped your world more than you realize. From the value of your pension fund to the cost of your wedding ring, this shadowy cabal has left its mark. In times of economic uncertainty, when trust in institutions crumbles like failing banks, people turn to gold as a safe haven. But what happens when even that refuge is controlled by an unseen hand? This isn't some conspiracy theory peddled on late-night TV. This is real financial history, hidden in plain sight. And it starts with 5 men gathering around a table in London, ready to decide the fate of gold, and therefore our global economy. So, buckle up as we embark on the money trail. Today, we're investigating the London Gold Fix, a century of price manipulation. We'll uncover how these meetings work, who benefits, and at what cost to the rest of us. Are you ready to follow the money? Because it leads straight to that table in London. 1919, the end of World War I. As Europe recovers from the largest conflict it has ever seen, a group of 5 men gather around a table in London. But they're not there to discuss peace treaties or reconstruction efforts. No, these men have come together to decide the fate of gold, and therefore our global economy. These are not just any men, but representatives from 5 of the most powerful banks in the world, N.M. Rothschild and Sons, Mocatta and Goldsmith, Pixley and Abel, Samuel Montague & Co., and Sharps and Wilkins. They formed the London Gold Fixing Company, an institution that would go on to play a pivotal role in setting the price of gold for nearly a century. The purpose of this new organization was simple, to provide a stable and reliable benchmark for the price of gold. Before the creation of the London Gold Fix, there was no standardized way to set the price of gold. It was bought and sold on the open market, with prices fluctuating based on supply and demand. But why did these 5 banks choose to take it upon themselves to create this new system? The answer lies in their own self-interest. Gold was, and still is, a crucial component of the global financial system. By controlling the price of gold, these banks could exert significant influence over the entire economy. And so, at 11 a.m. every weekday, these men would gather around their table in London and set the price of gold for the day. They would start by agreeing on a price, then use their connections in the gold market to buy or sell as much gold as necessary to maintain that price. This system worked well for the banks, but what about everyone else? By controlling the price of gold, these banks were able to manipulate the entire financial system to their advantage. And while the average person may not have realized it at the time, this new system would have far-reaching implications for the global economy. As we follow the money trail, we'll uncover how this secretive group of bankers continued to exert control over the price of gold, and how their actions impacted the rest of us. But first, we need to understand how the London Gold Fix worked in practice. So let's take a closer look at the mechanics of this powerful institution, and how it was able to maintain its grip on the global gold market for so long. The money trail continues as we delve into the evolution of the London Gold Fix, a seemingly innocuous term for what became a price-setting mechanism that exerted significant control over the global gold market. The London Gold Fix was born in 1990 when 5 major bullion traders came together to establish a standard price for gold, a practice that continues today, albeit with far-reaching implications. The 5 founding members of the London Gold Fix were N.M. Rothschild and Sons, Mocatta and Goldsmith, Pixley and Abel, Samuel Montague & Co., and Sharps Wilkins. These firms, steeped in history and tradition, formed a powerful cartel that set the stage for price manipulation in the gold market. At 10,030 AM sharp each business day, these members would participate in a conference call, later replaced by an electronic platform in 2015, to agree on a single price for gold that would clear the market. This process was known as the fixing, and the resulting price became the globally recognized benchmark for gold transactions. But how did this small group of bankers gain such influence? The answer lies in London's historical role as a global financial hub, and the fact that these firms held significant gold trading volumes. By coordinating their buy and sell orders, they could subtly shift market supply and demand to reach a consensus price. Over time, this power was consolidated further as smaller firms were acquired or driven out of business, leaving only a handful of major players. This concentration of power allowed the London Gold Fix to maintain its grip on the gold market for nearly a century, influencing not just the daily price, but also broader market trends and investor sentiment. However, this opaque system began to unravel in the late 2000s when regulators and investors started raising questions about potential manipulation within the gold fixings. As we'll explore later in the money trail, these concerns would ultimately lead to a shakeup of the London Gold Fix, but not before its members reaped billions in profits from their control over the yellow metal. In our next segment, we reveal how suspicions of collusion and manipulation tarnished the reputation of the London Gold Fix, and how regulators finally stepped in to bring transparency to this secretive world. Stay tuned as The Money Trail uncovers the truth behind a century of price manipulation. For over a century, the London Gold Fix has been the global benchmark for pricing gold. But this powerful institution has not been without controversy. At its heart are 5 banks: HSBC, Barclays, Societe Generale, Scotiabank, and Deutsche Bank. These financial giants have had the exclusive right to set the price of gold twice a day through a process that has long been shrouded in secrecy. The potential for conflicts of interest here is enormous. Each of these banks has its own trading operations, buying and selling gold on behalf of clients or for their own accounts. By setting the price of gold, they can directly influence their own profits. If a bank has a large position in gold, it could potentially manipulate the fix to its advantage. The London Gold Fix was born in 1909 when N.M. Rothschild & Sons, Mocatta and Goldsmid, Pixley and Abel, and Samuel Montague formed an association to set a standard price for gold. The system worked well for decades, but in the late 20th century, concerns about transparency began to emerge. In 1987, the U.S. Federal Reserve Bank of New York issued a report questioning the London Gold Fix's lack of openness. Despite these warnings, the 5 banks continued to operate with little scrutiny. Then, in 2013, Deutsche Bank suddenly announced it would withdraw from the fix, citing regulatory changes and reputational risk. This move sent shockwaves through the gold market and sparked renewed allegations of price manipulation. In response, regulators finally took action. In 2014, the UK's Financial Conduct Authority fined Barclays $44 million for failing to control its traders' attempts to manipulate the gold fix. The fine was a landmark moment, marking the first time a bank had been punished for such misconduct in the gold market. Meanwhile, the 5 banks themselves recognized the need for reform. In 2015, they replaced the old telephone-based system with an electronic platform, hoping to increase transparency and reduce the potential for manipulation. But critics argue that this is not enough, pointing to the continuing concentration of power in the hands of a few banks. As The Money Trail continues to investigate, we're uncovering a complex web of relationships and conflicts of interest at the heart of the London Gold Fix. Stay tuned as we follow the money trail, revealing the untold story of a century of price manipulation. The London Gold Fix, a seemingly innocuous daily conference call between 5 of the world's most powerful banks, has come under intense scrutiny in recent years. Critics argue that this tight-knit group of banks, HSBC, Barclays, Scotiabank, Societe Generale, and Deutsche Bank, have been able to manipulate the price of gold for their own benefit, to the tune of billions of dollars. The London Gold Fix was established in 1919 with the aim of setting a standardized price for gold that could be used by buyers and sellers around the world. The process involves the 5 banks coming together at set times each day to agree on a single price for gold that reflects current market conditions. This price is then used as a benchmark for trading in gold futures, options, and other derivatives. However, evidence has emerged in recent years that suggests the London Gold Fix may not be as fair and transparent as it claims to be. In 2014, Deutsche Bank agreed to pay $60 million to settle allegations of price manipulation in the gold market. The bank was accused of sharing confidential information about its trading activities with other members of the London Gold Fix, allowing them to artificially suppress or inflate the price of gold to their advantage. But the problem goes much deeper than a single bank. A report by the Financial Conduct Authority in 2014 found that there were weaknesses in the way the London Gold Fix was conducted, which could potentially be exploited by market participants. The FCA identified a number of concerns, including the lack of transparency around the pricing mechanism, the concentration of power in the hands of a few banks, and the potential for conflicts of interest to arise. These concerns are not new. In fact, they have been raised repeatedly over the past century, as the London Gold Fix has evolved from a small group of bullion dealers meeting in a physical location to a global network of banks connected by teleconference. Yet despite these concerns, the London Gold Fix has remained largely unchanged, with the same 5 banks continuing to wield immense power and influence over the gold market. As the money trail continues to investigate, we're uncovering a complex web of relationships and conflicts of interest at the heart of the London Gold Fix. Stay tuned as we follow the money trail, revealing the untold story of a century of price manipulation. For over a century, the London Gold Fix has been the global benchmark for gold pricing. But as the money trail continues to dig deeper, we're discovering that this supposedly neutral system has been manipulated for the benefit of a select few. The 5 banks responsible for setting the gold fix, Bank of England, HSBC, Barclays, Scotiabank, and Societe Generale, have wielded immense power over the market, with far-reaching consequences for investors and the economy at large. The London Gold Fix operates by establishing a single price that reflects the balance between supply and demand for gold. However, evidence suggests that these banks have been colluding to manipulate this price, often to their own advantage. For instance, in 2014, Barclays was fined $26 million by UK regulators for attempting to manipulate the gold fix in order to benefit its traders' positions. This is just one example of how banks have been able to exploit the opaque nature of the London Gold Fix to their own ends. Price manipulation has severe consequences for investors who rely on the accuracy and fairness of the gold fix to make informed decisions. When prices are artificially inflated or deflated, it can lead to significant losses for those who have placed their trust in the system. Moreover, such manipulations undermine confidence in the market as a whole, discouraging investment and stifling economic growth. The London gold fix is not only a localized issue, its impact reverberates throughout the global financial landscape. As one of the key benchmarks for gold pricing, any distortion in the fix has far-reaching consequences for commodity markets, central banks, and investors worldwide. By allowing this manipulation to continue unchecked, we risk eroding trust in our financial institutions and undermining the stability of the global economy. As the money trail continues to follow the money, we'll be shining a light on these hidden practices and holding those responsible accountable for their actions. Stay tuned as we delve further into this complex web of relationships and conflicts of interest, revealing the untold story of a century of price manipulation in the London gold fix. For decades, the London gold fix has been a cornerstone of the global gold market, setting the benchmark price for the precious metal twice daily. But as the money trail investigates, this seemingly innocuous process has been tainted by allegations of price manipulation and conflicts of interest. Let's take a closer look at some of the previous investigations and regulatory actions related to the London gold fix. In 2014, following a multi-year probe, the UK's Financial Conduct Authority imposed fines totaling £92.8 million on 5 banks involved in setting the gold fix: Barclays, HSBC, Société Générale, Scotiabank, and Deutsche Bank. The FCA found that between 2004 and 2014 marked a turning point in the history of the London gold fix. After a lengthy investigation, the UK's Financial Conduct Authority imposed hefty fines totaling £92.8 million on 5 banks involved in setting the gold fix: Barclays, HSBC, Société Générale, Scotiabank, and Deutsche Bank. The FCA uncovered unacceptable practices between 2004 and 2013, including attempting to manipulate the precious metals price-setting process through inappropriate communications. The regulator's actions sent shockwaves through the financial world, drawing attention to a critical need for increased transparency in the gold market. This watershed moment opened the door to long overdue reforms and a re-evaluation of the London gold fix's role in setting global gold prices. As part of this shift, the London Bullion Market Association introduced significant changes to the gold fixing process in 2015. In an effort to promote transparency and restore confidence, the LBMA replaced the twice-daily telephone conference with an electronic, auction-based system that allows more market participants to take part. The new method, called the ICE Benchmark Administration's Gold Auction, aims to minimize potential manipulation by reducing reliance on a small group of banks and increasing overall liquidity in the gold market. These developments have led to greater scrutiny of other precious metals benchmarks as well. In 2016, the FCA extended its oversight to include the London Silver Fix, Platinum Fix, and Palladium Fix, ensuring that these markets would be held to the same standards of transparency and accountability as gold. However, despite these positive steps, concerns remain about potential conflicts of interest within the gold market. For instance, major banks continue to hold influential positions in both setting benchmarks and trading on those very same benchmarks. This blatant conflict highlights the importance of ongoing vigilance and further reforms to fully restore trust in the system. As we bring our investigation into the London gold fix, a century of price manipulation, to a close, it's crucial to remember that transparency and fairness are never guaranteed. They must be fought for tirelessly by regulators, market participants, and citizens alike. The future of the gold market, and indeed all financial markets, hinges on our collective ability to demand and maintain an open, honest, and accountable system for setting prices and trading commodities. By shining a light on past abuses and advocating for meaningful change, together we can create a more stable and equitable financial landscape for generations to come.